Welcome, everybody. This is Edgardo, Balentine.
And this is Scott DiGregorio, and welcome to the Real Estate of Tomorrow podcast, where we're going to discuss the rapidly changing landscape of the real estate industry.
And the steps that you need to take today in order to survive tomorrow.
Look, I'm going to give you the perspective of a 25-year veteran, somebody who has been there and done that.
With Jesus' life for all fart, okay?
Screw you, man.
Look, I'm going to give you a fresh perspective from somebody that's applying those steps today.
So that basically means you're young and you don't know shit.
All right. Let's get this started. All right, everybody, welcome to the Real Estate of Tomorrow podcast. I am Edgardo Balentine, and I'm here with my co-host,
Scott DiGregorio. What's up?
So, dude, big things today, right? We're going to talk about big changes in mortgages. And look, I know this is not necessarily the topic that everybody wants to talk about, but this is the thing, man. At the end of the day, we are mortgage lenders. And if anybody that listens to this podcast hears about these big changes in the industry and they don't hear it from us, I will feel like, come on, man, like, really? You guys talk about like all this shit and you're not talking about like this thing that is really gonna affect me. So anyways, that's all to say. We're gonna talk about the changes in the industry. There's 2 or 3 things that are, I think they're going under the radar, you know?
I think so too.
Right? Like it's big changes. It's things that is actually gonna affect things like affordability, and it's gonna help a lot of people get into houses, which is what we need. However, because of the technicality of it, I think it's not being talked about enough. So let's put it in plain English and in a language that it's easier to understand. Because, dude, I mean, some of this communicates from, FHA and
that
VA.
FHA mortgagee letter, I misread it first. So,
oh my God. Yeah. And I didn't, and you told me what it said, and I'm like, well, I guess that's what it says. So anyways, why don't you start?
Yeah, so look, let's stick on the FHA topic. So, for those of you that don't know, FHA charges 2 types of mortgage insurance. They have something called an upfront that is kind of financed into the loan. And then there's a monthly mortgage insurance payment. And they just significantly reduced the monthly mortgage insurance payment.
So the mortgage insurance, just to stay, in that for a little bit, it's what people hear about PMI, right? Technically, I know it's not technically PMI, but, what you hear, oh, am I going to pay PMI? I'm going to pay PMI. The way it works is on a conventional loan, that mortgage insurance is going to be based, the monthly mortgage insurance is going to be based on your qualifications.
Yes.
So let's say I'm buying primary residence, that's going to change my mortgage insurance than if I were to buy an investment property, or if I was to put more down payment or less down payment, or my credit. There's 100 of things that are going to change how much that mortgage insurance is going to be. Where in FHA, as long as you have a 580 credit score and you're putting less than 10% down,
it's all the same.
It's going to be the same, whether you have a 580 or an 800.
Right.
So this is actually very powerful because now everybody on FHA is going to get a huge discount on that mortgage insurance,
Absolutely.
Which is going to make it super competitive now.
Yeah, and look, let's put some math behind it here. So on a $300,000 loan, it used to be 0.85, so that's $2,550 a year. So, let's call that $211 a month. They've lowered it from 0.85 to 0.5. So now, instead of that $2,550 a year, we're down to $1,500 a year on a $300,000 loan. That's a saving of roughly $80 a month, $90 a month. It's a big difference. Now, let's go a step further, bro, but what does that mean for borrowing ability? Well, that means somebody could borrow an extra probably $15,000, or it depends on rate, but let's call it an extra $15,000 for the exact same payment that they would have had with the older mortgage insurance.
Yeah, so that's huge. I mean, just overnight, by virtue of this change, basically, somebody that was looking at a $300,000 property, like you say, now qualifies for a $315,000 with the exact same payment. So look, that's what I mean. It's actually a step towards solving the issue that we have right now. And let's be honest, we don't get a lot of changes for the better. when it comes
Yeah.
to anything coming from the government.
And look, this is the government's response, right, to people wrestling with the housing market, and I get it. Now, there was another change in that mortgagee letter that doesn't affect us too much, would maybe affect you down in Naples, but there used to be on a high balance FHA loan, when the loan amounts get, to our, shout out to our California peeps, it used to be above a certain loan amount, the mortgage insurance would get even more expensive, and they've removed that tier. So now the mortgage insurance is the same up to the conforming loan limits, which is whatever it is now, 7 and change. So that's another significant change. Again, not something you and I deal with much, unfortunately. But but being that people are listening to this all over the country, I think that's also worthy of mention. So,
All right, so that's number one.
Number
FHA got a lot more attractive because we just got a big discount basically overnight.
yes.
All right, so that's huge. Then number two has to do, let's stay with the government loans.
Yep.
So let's go to VA loan. What was the change in the VA
So
loans?
it actually hasn't. I don't think it's actually been announced yet, but they're going to be lowering.
Here first.
Yeah, they're going to be lowering the funding fee. Okay, so I mentioned a minute ago, FHA loans have this 1.75% upfront mortgage insurance
Across
that's
the board.
financed and across the board. VA also has funding fees. Now, if you have a certain level of disability with VA, you're exempt and blah, blah, blah. But either way, there's a funding fee on VA loans, and they're going to reduce it. Well, we could give an update as to how much they're going to reduce it. But the good news is this. The government is taking steps within their programs that they control to try to address the affordability issue that's going on in the country. And this is a positive step, obviously.
Yeah, and actually, look, a lot of times my concern with the announcements that we get from the agencies is that they're not very impactful to the end consumer. They sound good, oh, this is gonna work, but in reality, when you actually try to qualify somebody, there's really not a big impact to them. Or these are fake programs that, maybe you can do 1 or 2 in a year, but they're really not that helpful. This is something that an FHA loan is the most common loan for a first-time home buyer. So much so that people think that you have to be a first-time home buyer to get into an FHA loan.
Incorrectly, but yes.
Incorrectly, yeah. But that's because it's so popular for first-time home buyers. So my point with this is they made a positive change on 2 of the most popular loans. So we're very happy with that. Now,
at the same time, the government's making positive changes. Fannie Mae and Freddie Mac are making negative changes. But,
see, I'm going to push back on that a
pros and
little
cons,
bit.
I
Yeah,
guess.
I'm going to push back from that a little bit. So this is the thing that's happening with Fannie and Freddie. And again, there's, not to get super technical here, but when it comes to mortgage rates, it's, even though we think, well, what's, so-and-so company's rate if I have a 800 credit score, there's a lot of different things that are going to affect that rate.
There's 31.
There's 31.
Yeah,
Okay.
31 factors that impact an interest rate.
And we're talking about the type of property that you're buying, like if you buy a condo versus a multifamily or a detached property. We're talking about the down payment. Obviously, there's some obvious ones like the credit score. We're talking about, what else? How much your debt to income is in a lot of cases. So there's a lot of different things that are going to affect what your final rate is going to be. And those are called the LLPAs, the loan level price adjustments.
And just to throw it out there, anybody listening to this, if you're sitting in front of a computer,
Yeah, sure.
you can Google Fannie Mae LLPA, and the matrix comes up. And that's the matrix that every mortgage company, every bank in America uses, because those are imposed from the agencies, from Fannie and Freddie.
Yeah, it's not a bank-specific thing. So they announced that they're gonna do an update on these LLPAs, and which means is they're going to change how they weigh certain things and increase the rates more with certain parameters, like let's say, credit scores and things like that, and decrease how much the rate gets impacted by other parameters.
And look, let me throw this out there, because I think this is something where you and I could. This is just so second nature to us, right? But you might be listening to this and thinking, well, what the hell? Like, what the hell does all this matter? Look, the more risk in a loan, the higher the rates. If you were lending me money, and I was a multimillionaire, and the loan was secured, the loan you're giving me was secured by a piece of real estate with no other debt on it, that's a very low risk loan to you. So you wouldn't want much of a return. But as the risk increases, you're going to want a higher rate of return to make that worthy. And how these risk factors are calculated is just data.
It's just data, but this is where I think this becomes very interesting. This is why I feel like we're talking about this. There's two things that were pretty interesting, at least to me. One is, yes, if you think of this conceptually, the more money down you put on a property, the less risk this property is going to have.
I know where you're going with this.
However, going back to the mortgage insurance, if you were told if you put 20% down, you don't have to pay mortgage insurance. Well, this is the thing. If you're an investor and you're giving out the money and somebody puts less than 20% down, but they're paying for an insurance on that loan, well, that loan is not as risky as a loan where the person puts the bare minimum amount to get that mortgage insurance removed.
Correct.
So if a person puts 20% down, and this is like a little secret in the mortgage industry, 20% down payment versus a 15% down payment, the 20% down payment is going to have a higher rate because it's viewed from the investor as a higher risk than a 15% down payment because there's that insurance.
Right, and the mortgage insurance actually covers up to us to 72% finance because they'll give us the spread there. And obviously on 20% down, we have 80% coverage. So
right.
There's a lot of that, people think, it's just interesting when you start applying this to a lot of real world situations. But some of the new things that they're adjusting for now, it used to be for loan to values, for down payments, it used to be at 40% or more, everybody got, that was just one bucket. And then, so 60% financing or less was best case scenario. The new LLPA chart goes all the way down to 30% financing.
Yeah, and the other thing that got better is loans where you have a lower credit score and a lower down payment. Don't get me wrong, they're still going to have a higher rate than if you put than you have a higher credit score, but they're not going to be as bad as it is today. So the change is actually helping the people that put less money down and don't have a great credit score because they're not getting quote unquote hit or punished as hard as they are being today. And I think this is another step by the agencies to try to make house a lot more affordable for people that maybe don't have all the means to put a very strong down payment and have a great credit.
Yeah, and 100%, and that's a good thing. And then they've also introduced for the first time ever, if your debt to income ratio...
Wait, let's not get out of the way. Let's not get out of that for a second. What's interesting, because there's some negative too, besides the debt to income, but what's interesting too is that the way that they are, quote unquote, subsidizing this, the way that they are making it, cheaper if you have a lower credit and a lower down payment is because they're hurting people that have a higher credit and a higher down payment more than they are today.
Yes.
So they're increasing those rates more than they are today in order to decrease the rates for the people that are putting less money down with a lower down payment. So I thought that was a bold move by the agencies because that's the part that it's a little counterproductive, but I think it's trying to help the people that are actually trying to get into primary residence that are not completely, A credit or whatever.
Yeah, I mean, look, the government's taken a lot of steps to try to make home ownership available to first-time home buyers and middle-class Americans and whatnot. And it's nice to see. It's nice to see the acknowledgement. Now, do I think the changes are going to massively impact the percentage of first-time homebuyers offers that get accepted and that type of thing? It'll certainly help. It's certainly not, though, going to flip the market upside down on its head.
Right. All right. So now, what about the DTI?
So
what is DTI?
Yeah. So debt to income ratio, right? Is you take all of your debts divided into your income, and that's your debt to income ratio, and so it's expressed as a percentage. And there's never been a debt to income ratio loan level price adjustment. until this new charter. By the way, this chart goes into effect for all loans delivered to the agencies May 1st and beyond. So, so in the next 30 days or so, some lenders have already implemented it. But within the next 30 days, I would say everybody will have it implemented. So, but now there is a new bucket, if you will, where if your debt to income ratio is equal to or greater than 40%, there's some adjustments for that as well. And that's an entirely new bucket that's never existed before.
Yeah, a couple things about that. One, the Bankers Association, our lobbyists, if you will, are pushing very hard to, at the very least, postpone that one thing.
Yes.
And two, this one, I think, out of everything we're talking about, is the most impactful one. Because in this particular case, it's not going to be something that just happens automatically, right? The FHA reducing it applies to everybody. Your credit is your credit. So if you have a credit score of whatever, then this is what your rate's going to be. The thing with income is something that we calculate, right? Mm-hmm. A lot of people that are self-employed, that have variable income, if you get approved based on one income, but then go under contract or get locked on a rate based on a different income, that can change the rate more than it did before, because if it goes over that 40% debt to income ratio, it can really affect you when it comes to the rate. So little things like, questions where, should I use my spouse in this mortgage or not? Now you're gonna start getting answers where the loan officer is gonna tell you, yes, because that's gonna lower the debt to income ratio. Even though you qualify on your own, adding a spouse or adding more income will help you with the rate, which wasn't the case before.
Of course, and I'll go in a different direction with this. How accurately is income being calculated? I'm doing a loan for an investor now. His previous loan, which he did recently, so same tax returns we're working off of, they calculated his income at $6,000 a month. He needed a co-signer to make the deal work. I went through his taxes, found a whole bunch of depreciation, and raised his income from $6,000 a month to $23,000 a month.
That's a huge
And the
difference.
last loan officer and underwriter just missed it. So, in this environment now with this 40% thing, is every nickel of income being squeezed out of that self-employed tax return? Because now 39 versus 41 matters.
Yeah, and look, guys, for your consumers out there, right now, it's the easiest time for somebody to misquote rates because of the 31 points that you actually need in order to quote rate accurately, because we don't really know what the final income or what income the other lender is calculating to give you the rate that they're giving you. So there's a lot of things.
I want to mention one other thing on that, though. And with what you just said, all the interest rates you see online are bullshit.
Yeah.
Okay? That is a best case scenario, perfect everything. Everything's perfect. And that applies to a minuscule percentage of, so especially now that they go down to 30%. So the best interest rates out there are 70% down payments. Okay, if your agent's listening to this, I want you to ask yourself, how many of your clients put down 70%? Because in my mind, once you get much more beyond 50%, you just go cash.
Just go cash.
So now you need 70% financing, perfect debt to income ratio, blah, 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 blah. I mean, it's just bullshit.
All right, so I want to close this the way we started it, with the positive things, right? So there is a silver lining to all of this. A couple of things. One thing, there are some programs out there that if you don't make more than a certain amount of money, that you're not gonna be subject to this LLPA changes, even the debt to income one. So, keep that in mind. There's some programs that if you are not over 80% of the adjustable,
The area median
income, then you are gonna be able to be exempt from these things, and your rate's gonna be a little better. Your mortgage insurance is gonna be a little better. Number two, if you're a first-time home buyer and you don't make more than a certain amount, now you're not subject to this. So actually, the first-time home buyer benefit got a little better. Not because it got better, but because everything else got a little worse.
Yeah. No, it's 100%. And look, if you look at the changes to FHA, the changes to VA, and the changes to Fannie and Freddie across the board, they're designed to help, again, first-time home buyers, middle-class Americans. So that's unequivocally a positive.
And that's it, guys. That's what we just nerd out on mortgages for the last 20 minutes. I hope you enjoyed it.
All right, guys, listen, man, make sure you spread this around. Make sure you have this knowledge. As we say all the time, to be effective in the real estate industry of tomorrow, it is critically important that you are in the know. You do not need to know mortgages as well as we do, but you need to be able to intelligently speak about mortgages the same way Edgardo and I need to be able to intelligently speak about real estate contracts. So you heard it here first. Spread this around. It's the best damn podcast in the real estate industry. You know it. We know it. I'm Scott DiGregorio. I'll see you on the next episode.
See you guys. Well, thank you guys for listening. And now it's your turn to implement everything you learned today.
Look, you have a question, you have a topic for a future episode?
Share with us.
Yeah, tell us what you're doing. What are you doing today so you could be successful tomorrow? Send us an email at success@realestateoftomorrow.com.
And don't forget to leave us a review, an honest review.
Screw an honest review. Leave us a 5-star review. And for every 5-star review we get, we're going to send you a badass real estate meme t-shirt.
Those shirts are hilarious.
See ya.